segment sponsored by Mears and Associates.
Well, in our financial corner on this Monday, we are talking federal income tax and some low-cost ways to fund it. Here with more now is Mark Mears from Mears and Associates. And Mark, it's always good to have you back on the show.
Good to be here, Lasha. You're always looking very nice.
Thanks. Happy Monday.
Happy Monday.
Kicking off another work week.
Absolutely.
But you're talking about IRAs, you're talking 401ks.
Traditional IRAs and 401ks. And have to give a quick disclaimer, any questions about taxes, we're talking about general concepts.
Right.
You need to consult with your own tax advisor or CPA. But yes, traditional IRAs and 401ks. And real quick, I want to give a shout out to our friends in Telford, Bowmantown, and Limestone.
Oh, very nice.
Yes.
Good morning. Hopefully we have lots of viewers in that area.
Yes, yeah.
So when we're talking about these, you're talking about the income tax portion,
Yes.
which you say a lot to consider, and it can be obviously overwhelming.
A lot to consider. And you like Jeopardy questions.
Oh, oh, I love Jeopardy on a Monday.
So this is an easy one. If I were to ask most people that over the next 10 to 20 years, if they thought federal income taxes were going to go up or going to go down, which do you think they would say?
I mean, like all things, we just have this feeling that they're going to continue to go up.
They will continue to go up. So your biggest enemy in a traditional IRA or 401k is not maybe the stock market going bad. It's not maybe interest rates on a CD not being satisfactory. It's taxes. They're going to get their bite either way. So on a traditional IRA or 401k, when anyone other than the spouse inherits the IRA or 401k, and this is an average, the tax can be up to 30%.
Wow.
And there's no way around it. You have to pay that tax according to the federal income tax code. And most people that I talk to don't want to spend the money while they're alive. They want to hold on to it for their children or their grandchildren. So that's who the tax hurts the most. It's the children and grandchildren.
The next generation.
Next generation. So there are methods that when you die and this wealth passes to someone other than your spouse, it can be replenished within 90 days tax-free. And too complicated, obviously, to talk here about.
In a minute and a half.
Oh yeah, but it can be done. It can be done.
And obviously the important thing is to sit down and find out where you want to be, where you want it to go in those next several years so that you can have that conversation and maybe
That's right.
do something now.
You know, most people, as a general rule, when they die, someone other than their spouse, they can pay the tax in a lump sum or they can spread it over 10 years. But either way, that 30% is a big tax bite. And let us show you how to keep that wealth in your family so it can be for all your future generations.
Passed down. All right, certainly an important topic. We're going to give everybody some information. If you would like to learn more or have additional questions, you can find him, of course, right there on Fort Henry Drive in Kingsport. You can check out the website for more, markmears.com.
The preceding segment sponsored by Mears and Associates.